One of the most important elements of any plan for retirement is what you spend. As you reach your 50s, one important goal to focus on is paying off your mortgage and other debt before you retire. We'll take a look at how the average American spends and why not having those payments can improve your chances for success. That's all coming up right now. Hello, welcome back to Wealth Wednesday, our bi-weekly show to help you plan for something better. Today, I'm joined by financial advisor Nikki Ludy, who's in our Woodsfield, Ohio office, and we're talking about helping people plan for retirement and focusing on their spending levels. It's critically important to reducing the long-term risk of your golden years. Let's take a look at how the average American age 65 and older spends their dollars in retirement. You can see here by this chart that housing payments and car payments account for almost 30% of an average retiree spending. Nikki, I think the thing that sticks out to me is the cost of a mortgage. And nationwide, this affects about 52% of the population 65 and older. This amounts to roughly $762 per month or $9,100 per year on average. My question is this: if you're in your 50s, should eliminating that mortgage before retirement be a higher priority?
I would say if it's within reason, then yes, absolutely. Paying down your debt early definitely sets you up for a better success and not running out of money by eliminating those payments. The less debt that you have, obviously, the less risk that you have of it going further into retirement. If you have that mortgage paid off early, it can help you potentially retire earlier because you're not trying to kind of lift the hurdle of paying that down every month. Or you can retire with a smaller nest egg and try to make it work. You can spend your money on more enjoyable things, quite honestly. No one really likes to pay their mortgage payment every month, but it's a necessary evil, right?
Absolutely. So, we don't want to do this irrationally and make big mistakes. So what are some strategies people can do to kind of attack that in a very reasonable way?
Well, I think a couple of things. Just putting more extra monthly income towards your mortgage payment, if that's possible. If you have an extra few $100s that you can pay towards it, paying that down over time, those smaller extra payments will make a difference in the long run. If you have some money set aside in savings that you're really not planning to use, using that money to pay down the principal also is another way. But I think, so one of the biggest things that I would not advise people to do is draw money down from their IRAs or 401ks, taking money from these retirement accounts and taking that out in usually what is people's highest income years usually does not make sense. Taking out these big lump sums, paying big tax liabilities, it just leaves you with a smaller nest egg during retirement, which I tell most people, if you're thinking about taking from your IRAs or 401ks, wait until you're retired to do that when your income is much lower.
And spread it out too, right? So
Right.
Another thing that we're looking at on these charts is transportation costs, and car payments can also be a significantly larger expense for most people. So it's difficult to pay cash for a vehicle anymore because of the high prices. So we often get to the point where we're taking on debt to do that. But if you carry that debt into retirement, again, you've got, between housing and transportation costs, you've got almost a third on average of your expenses going towards debt service. So you may want to look at, can you cut down to one vehicle? Can you buy used or extend the life of a car? And one of the other things that you might want to think about is build in a $30,000 to $50,000 purchase into your plan over time, every 4 or 5 years or every 8 years or whatever makes sense to show what the impact of buying a car might be on your overall situation. Nikki, younger people who are watching this have a really good opportunity to impact the tax side of this. And that's really only about 5% to 6% of retiree spending. But for younger generations, it can be even less. How so?
Well, I think the younger generation definitely needs to look at either the Roth IRA or the Roth 401k. I mean, the long-term tax advantages of these types of accounts can't be emphasized enough. Over the past, few decades, the most popular way to save for retirement was in a pre-tax retirement, either 401k or IRA, which means that you pay the tax, you get the tax deduction when the money goes in, but you pay the tax when it comes out in retirement. The Roth is just the opposite of that. You get no tax incentive today, but in retirement, those assets come out income tax free. And so when you take from those types of accounts, you don't have to adjust for taxes. So, I mean, in an example, if you need to take $1,000 out of a pre-taxed account, you may need to take out $1,250 just to account for the taxation of it. If you're taking money from a Roth account, that same $1,000, you don't have to account for the taxes. So I think there's a lot of incentive. We say the younger generation, mainly because they have the most years to save until retirement and the time for that money to grow over time. And that's where the big benefit is here.
Yeah. So when I was going through this Bureau of Labor Statistics report, one of the more interesting things I noticed was how spending decreases for the 75 and older demographic. And this relates a lot to what we see in real life too. You know, inflation has an impact on many things that you're buying over time, but we also see that as you get older, the average American is spending less. And this is something we've seen as well. So typically, a lot of times when we model this, we don't model as much of an increase. We kind of assume that things will stay fairly constant. And the impact this has is to be expected. You know, if you're not spending as much later on, then, you know, your assets are going to stretch out a little bit further than if you assume that continuously increasing those expenses every year. So, you know, keep that in mind as you're also planning for retirement, that you're probably going to spend more earlier in your retirement time than you are later. And if you do carry a mortgage in to retirement, there's a chance that you'll have it paid off and those expenses will decrease over time as well. Nikki, spending's huge. Any final thoughts today?
Yeah, I think you're right. I mean, you know, most people when they first, you know, retire, maybe they're in their 50s and 60s, you know, that's when they're going to probably do more traveling and they're going to spend, you know, a little bit more, but then slowly that decreases just with age and health, you know, can kind of hamper those types of things. So I think it's just important to model these projections and to understand your own lifestyle on what you do spend, and a financial advisor can help you do that.
Thank you so much for joining me today, Nikki. If you have questions and you'd like to talk to one of our financial advisors, visit cfswv.com. Thanks for watching. Have a great week.